everyone, welcome back to Imarticus Learning. Ever feel overwhelmed by investment decisions? Like, should you put money into a new project or keep saving? Well, businesses face this same dilemma, but on a huge scale. Imagine deciding whether to open a new branch, buy fancy new machines, or invest in a new product line. So, how do they decide? With capital budgeting techniques. And I'll show you the ones the pros use. Think of capital budgeting like planning a dream vacation. Let's say you are deciding between going to Bali or Paris. You'll check costs, potential experiences, maybe even how many vacation days you'll need. Capital budgeting is just like that for businesses. They are deciding where to invest money for the best long-term return, whether it's a factory, new tech, or even expanding to a new country. Capital budgeting helps answer, will this investment make us more money than it costs? Let's look at how companies use it to make big decisions. Capital budgeting is like planting a tree. You are not just planting for today, you are growing it for fruits in the future. Strong budgeting decisions make companies grow, give them stability, and protect them from financial storms. With the right investments, company can ensure their tree is fruitful for years to come. Let's dive into 4 essential techniques. Net present value, NPV, internal rate of return, IRR, payback period, and profitability index, PI. Ready? Let's break it down. Imagine you are buying a snack cart that you hope will bring in lots of cash. NPV helps you see if you'll earn more than the cart's cost over time. It's like getting a sneak peek into your future earnings to decide if the investment's worth it. Say you spend rupees 50,000 on the cart and earn rupees 10,000 a year for 5 years. If NPV says you're coming out ahead after costs and inflation, you are golden. Next, we have IRR. Think of it like speed on a racetrack. The faster your returns, the better. IRR is the rate where your profits match your costs, so you break even. The higher the IRR, the faster your investment car is racing ahead of cost. Imagine 2 investment cars on a track. The one with a higher IRR is zipping ahead, and just like a race, that's the one you are probably rooting for. Now, for the payback period, think of it like a personal loan. You want to know how long it will take to get your money back. If you buy a scooter for rupees 20,000 and earn rupees 5,000 every year, it will pay you back in 4 years. Simple, right? This technique is great for companies that want quick returns, though it doesn't consider the time value of money. Last but not the least, the Profitability Index or PI. Think of it as the value per rupee invested indicator. PI is the ratio of future cash flows to the initial investment. If PI is above 1, the investment is a win. For example, a PI of 1.2 means for every rupee invested, you are earning back rupees 1.20. It's perfect for comparing projects when you are deciding where to allocate funds. Let's see these in action. Take Tesla. Before they invest in new factories or technology, they calculate NPV and IRR to decide if it's worth the cash. Another example is Amazon's R&D investments, where they use PI to decide if a new tech project will boost returns in the long run. So, how do you choose the right technique? NPV is great for seeing overall profit. IRR gives you a return rate. The payback period is best for quick recoveries, and PI is perfect for ranking multiple projects. The choice depends on what you value most: total return, rate of return, quick payback, or efficiency. And that's a wrap on capital budgeting techniques. Now, when you see companies investing big, you'll know they have crunched the numbers to find the best possible return. Thanks for joining me. Be sure to hit that like button if you enjoyed learning. Subscribe for more content with Imarticus Learning and drop a comment on which technique you found the coolest.